Each investment has a certain amount of risk. Risk also refers to the likelihood that an investment's value could deviate from expectations by rising or falling. Despite the fact that the majority of people primarily identify risk with losses. Simply put, risk is a measurement of the difference between the actual return on an investment and the projected return. The returns on less risky investments are normally lower, whereas the returns on riskier investments could be higher. In this video, we will discuss different types of investment risk you may be exposed to as an investor. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 10. Business and financial risk. Business risk, also known as operating risk, is the risk associated with the routine day-to-day operations of the organization. Financial risk, including debt and preference shares, originates from the use of fixed-cost securities. When sources and uses are taken into account, business risk refers to the potential for loss and the unpredictable nature of return resulting from a firm's use of capital. Financial risk is the potential for loss and the variation in an owner's return brought on by the funding sources of a company. To further comprehend this critical distinction between business and financial risk, let's take a closer look at the income statement in Exhibit I. EBIT, or earnings before interest and taxes, can be viewed as the business operating profit, or its profit before deducting taxes and financing expenses. Business risk is focused on earnings before interest and taxes, whereas financial risk is focused on earnings available to stockholders. The possibility that a business would fail because its assets couldn't generate enough earnings before interest, and the unpredictability of those earnings are the two components of business risk. The two elements of financial risk, namely interest expense and preferred dividends, are the likelihood that a company will fail as a result of its inability to make interest and/or principal payments on debt and the fluctuation of earnings available to equity holders due to changes in fixed funding. The second component of financial risk is the extent to which earnings available to stock investors would fluctuate at a faster rate than earnings before interest and taxes. If the business doesn't employ debt, there won't be any financial risk. Number 9. Liquidity risk. Danger associated with being unable to sell your investment at a profit and withdraw your funds when you need to. You might have to settle for less money if you want to sell the investment. It might not be feasible to sell the investment at all in some circumstances, such as with exempt market assets. Number 8. Concentration risk. The danger of losing money if all of your funds are concentrated in just one investment or class of investments. By diversifying your investments, you may spread the risk among several asset classes, sectors of the economy, and geographical regions. Number 7. Inflation risk. The possibility of losing buying power as a result of investments with values that do not keep pace with inflation. Over time, inflation reduces the amount of money that will buy the same amount of goods and services. If you own cash or debt investments like bonds, inflation risk is especially important to consider. Since most businesses have the ability to raise the prices they charge customers, shares provide some protection against inflation. Therefore, share prices ought to increase in step with inflation. Due to landlords' potential to raise rents over time, real estate also provides some security. Number 6. Purchasing power risk. When they want to retain their financial position over time, investors choose investment venues whose values fluctuate with the price level. To counterbalance rising living costs, they opt for investments whose market values fluctuate with consumer prices. They will find that their entire wealth has diminished if they don't. The decline in investors' purchasing power over commodities and services is the economic crippler of inflation. Essentially, investors need to be worried about the ongoing influence that their money has upon goods and services. Equation 1 shows how the market rate of return, the rate of price change, and the investor's rate of change in real purchasing power are related. X represents the change in buying power as a percentage as a result of an investment with an R-adjusted return on investment. If the interest rate is just equal to the rate of inflation, R equals APP, the investor's real rate of return is 0, X equals 0. A more plausible scenario would have the investor's rate of return R at 13% and inflation APP at 6%. The investor's true rate of return in this case, adjusted for inflation, is 5.66%, indicating an increase in the investor's purchasing power. Equity shares, according to some stockbrokers, are an inflation hedge that will protect their clients from the risk of losing buying power. It's a little over the top. Number 5. Reinvestment risk. The danger of losing money while reinvesting capital or revenue at a lower rate of return. Consider purchasing a 5% paying bond. If interest rates fall and you are required to reinvest the regular interest payments at 4%, you will be subject to reinvestment risk. If the bond expires and you are required to reinvest the principal at less than 5%, reinvestment risk will also be applicable. Reinvestment risk won't be an issue if you plan to use the principal at maturity or the regular interest payments. Number 4. Market risk. Equity shares have a significantly larger market risk than bonds do. Earnings and the price and value of stock shares have some correlation. Theoretically, capitalization rates for earnings that support current and future dividends should create yields high enough to cover the underlying risks. The pricing of bonds are, however, greatly impacted by changes in the interest rates on new debt. Equity prices are primarily impacted by financial risk concerns, which in turn affect earnings and dividends. However, general psychology, abrupt changes in financial sentiment, and waves of optimism or pessimism may have a substantial impact on equity prices. Gamblers and speculators yearn for action while their emotions are high. They can't help but take part in the market since they have such a strong desire to profit. They are not afraid to look at the competitive landscape. They don't adequately evaluate the underlying variables upon which their judgments are based. Instead, they swiftly enter the market and influence prices much beyond what is reasonable. Greed drives up prices while fear drives them down. The core market risk is, in essence, the possibility of experiencing capital losses as a result of price volatility caused by a speculative mood. Number 3. Interest rate risk. Interest rate risk still applies to all bonds, whether they are held by an investor for a long or short period of time. Interest rate changes have the greatest impact on the market price of long-term bonds since the longer the bond's maturity period, the greater the impact of an interest rate change will be. However, changes in interest rates may result in a large shift in the interest income on a portfolio of short-term bonds. From one period to the next, while having no impact on the market price of short-term bonds. Changes in interest rates therefore have an effect on investors in both short-term and long-term bonds. Number 2. Social or regulatory risk. There is a social or regulatory risk when an otherwise lucrative venture is affected by unfavorable legislation. A harsh regulatory environment, or, in the worst scenario, nationalization by a socialist government. Price controls could reduce industrial companies' profits, and rent controls could have a substantial impact on the value of rental property used as a hedge against price increases or as a passive income source. Based on increasing government participation in corporate concerns, no industry can expect to be immune from the social risk because it is essentially political and therefore unpredictable. Number 1. Other risks. Other categories of risk, particularly those associated with investments in foreign assets, include the risk to the monetary value and the risk to the political environment. For the investor who frequently purchases foreign government bonds or securities of foreign corporations in an effort to obtain a slightly higher yield than obtained on domestic issues, firms, or the desire but inability of the foreign government or corporation to handle its indebtedness exists. The investor should carefully weigh the likelihood of the increased risks associated with foreign investments against his expected return, which can take the form of interest, dividends, or capital gains, while investing in foreign securities as opposed to domestic assets. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.